Hi there, accountants. I hope all is well, and I pray that as you are viewing this video that you are in the best of health and spirit. This video will cover Chapter 15, Introduction to Managerial Accounting from Financial and Managerial Accounting, 16th edition. So by the end of this chapter, you should be able to describe how managerial accounting supports the management process, its differences with financial accounting and its place within the organization. So as you know, financial accounting, that's generally tracking the day-to-day. What is the net income, the bottom line for the company, and managerial accounting, that is essentially what's happening within the organization itself. And managerial accounting helps management makes decisions. Financial accounting, on the other hand, external users, investors, creditors, they essentially use the financial statements to make decisions versus, again, managerial accounting, where management and internally individuals are using that information to make decisions. Objective 2 will describe and illustrate the nature of manufacturing operations, including the different types and classifications of costs. Objective 3, we will describe and illustrate a financial statement for a manufacturing business, including the balance sheet, statement of cost of goods manufactured, as well as the income statement. And we will also describe and illustrate the utilization rates in evaluating performance for service-based companies. So when we think of managerial accounting, we might think that, sometimes this only relates to manufacturing companies, those that are taking raw materials and putting together a finished product. But this can also apply to service-based companies, as we'll see. So we'll start off with objective 1, managerial accounting. Sometimes it is called management accounting, and it is essentially the process of developing information and management tools in order to achieve an organization's objectives. So although in this chapter is going to primarily focus on companies who have an objective to earn a profit, we also cover some other organizations because, again, much of what is going to be covered, this can also apply to these other organizations. So let's say nonprofit organizations, government agencies, a lot of the things that you'll learn in this chapter, because for most companies, management, they're going to need to figure out, strategic planning. They're going to need to measure, the actual outcome of what they are trying to do with maybe budgeted and planning and things that they put in place. They'll need to evaluate and then also put some controls in place. So when it comes to strategic planning, measurement, evaluation, and control, so strategic planning, this is where the management process begins to develop long-term objectives. And this normally involves a horizon of maybe 5 to 10 years. So like projecting what exactly the company wants to achieve. So maybe the company, they're, within their strategic plan, they're going to say, hey, as of right now, we currently have 1 brick and mortar location. In 5 years, we want to have 3. In 10 years, we want to have 10. So now the company, and again, it's much like in your everyday life, right? Let's say you have a goal to purchase a vehicle. There are some things that you're going to need to do. So we live in this day and age where a lot of people, they spend a lot of money when they reflect on their budget. A lot of times they're spending money on, buying food, right? Buying food outside, not cooking at home. So if you have this long-term goal, hey, I want to purchase a car within a year, then you're going to know that there's going to be certain decisions that need to be made in order to achieve that goal. Same thing as it applies to businesses. Next, we have operational planning, develops short-term actions for managing the day-to-day operations of the company. Next, we have measurement. So the management process, this is essentially where managers, where they develop and they agree upon different performance metrics on how well the company is achieving its objectives. And the reason why this is important is because the metrics, they need to focus into short-term as well as long-term objectives. Next, we have evaluation. So this is a process by which management, they're going to monitor operations by comparing what is actually happening versus the expected results, right? Because let's say we'll use the car example, someone who wants to purchase the car within a year. They're saying, hey, I am planning to only spend $150, let's say per month on eating out. So that's the budgeted, the expected result, but what's actually happening when they assess how much was spent for the month of, let's just say July, they spent $180. So now they realize, wait, hold up. Okay, so I overspent, and now they're going to have to evaluate what can be done to essentially meet that goal. So comparing the actual and the expected results. And then lastly, We have control, and this is the process by which management, they take actions to encourage specific behaviors or outcomes. So we're going right back to that car example, right? The individual spends a lot of money on buying food. They decide, hey, you know what, in order to ensure that I meet my goal of not spending $150 or more per month, I'm going to meal plan every Saturday or every Sunday or whatever day of the week they choose. They are intentionally choosing to control the outcome. Because a lot of times, if you don't prepare in advance, what they say, if you don't prepare to fail, then if you don't prepare to plan, or if you don't plan, then you prepare to fail, essentially, right? So I'm sure you get what I'm saying. But the key thing here, again, what we are learning, it's practical. It applies not just to businesses, but also to our personal lives. So next we just have an exhibit that goes over the managerial accounting schema. So again, with strategic planning, we want to focus on measuring, we want to focus on evaluations, and then essentially control. And then we're going to learn about some of these different things, the different cost systems, overhead allocation. Are there any variances? So again, this is comparing that $150, food delivery or food purchase budget versus how much you actually spent, 180. So there's a variance, there's a deficit of $30. You went over the budget. Then there's some fixed costs, right? So there's some things like rent. You don't necessarily have the ability to say, hey, this month I'm going to pay 1,100, next month I'm going to pay 700. Doesn't work that way. So rent, mortgage are generally fixed costs, phone bills, things of that nature. And then you might also have some variable costs, so some things that might change. So let's say entertainment. There's certain things that are subjected to change, and you have a bit more control over those things. So now we move on to developing management tools. So managerial accounting, it develops a variety of tools for management to use in analyzing information and making decisions. So that's the amazing thing about accounting. So a lot of times when people hear, that someone is an accountant or they're studying accounting, the first thing they think is, hey, you're really good with numbers. And although, a part of it is true, a lot of it is logic based, but then also the key thing is when you are, reading a book, you're reading and understanding what's happening, looking at the words, right? The words that are put together. When it comes to accounting, you're essentially telling a story, but you are using numbers. And it is very important to know how to analyze that information to ultimately make decisions. So some of the tools that management uses includes cost, volume, profit analysis. And this is important because it helps to determine the sales necessary to break even or earn a target profit. So let's say I start a water business, right? And I love essential water. I purchase essential water for $3. Am I going to sell it for $3? No, right? What's the main purpose of a business? Essentially to earn a profit. So if I purchase the essential water for $3, I'm going to flip it for $4. So that way, for every water that I sell, I earn $1, essentially. So companies, they want to know what is the necessary sales price. So that way they can either break even or earn a target, essentially. So very, very important concept in business. Budgeting for resource planning, decentralization in order to assess operations that are centralized or distributed throughout the company. Differential analysis for comparing the profitability of various options. So again, especially for companies, let's say, we're using managerial or manufacturing companies rather, when we move on to the next objectives, let's say we have a company and they are making different models of speakers, right? Or even a car company, they're making different models of cars. They want to determine, hey, how is model A, car model A doing compared to car model B, doing compared to car model C? And then from there, they want to determine, which car is most profitable. Hey, maybe we should discontinue manufacturing car model B because it's not really selling, right? Or they'll make changes. Maybe they'll figure out how to get a distributor that can sell car products at a different price or something of that nature. All right. Next, we have capital investment analysis, and this is used to decide long-term assets to purchase. So like property, plant, and equipment, and things of that nature. So here we see Financial accounting and managerial accounting. So as mentioned earlier, accounting information is often classified into two types. We have what's called financial, and then we have managerial. So this exhibit, it essentially shows the relationship between financial accounting and managerial accounting. So when you think of financial statements, or financial accounting rather, think of it as being used externally. So investors, creditors, they are essentially using the financial statements, the balance sheet, the income statement, the statement of stockholders' equity, statement of cash flows. They're using these financial statements to ultimately make a decision, right? The bank is going to decide based on the balance sheet and based on the net income of the company, I'm going to lend this company $1 million, or I'm not going to lend them $1 million, or an investor, right? We have the privilege, the opportunity with these apps like Robinhood and things of that nature, or brokerage companies, TD, Ameritrade, whatever it is. We can look at the financial statements and assess and say, hey, does this corporation pay dividends? Is this company profitable? And based on that, you can decide if you want to invest stock into the corporation or if you want to lend money to the corporation and receive bonds. So when you think of financial accounting, think of it being used by external users. Managerial accounting, on the other hand, this is used essentially internally. Management is making decisions based on the numbers. So here we see with financial accounting, financial statements, again, it's used externally. The nature of the information, it is objective. The guidelines for preparation, so GAAP. So GAAP is essentially generally accepted accounting principles. So when it comes to financial accounting, again, especially because external users are using the financial statements to make decisions. Let's say a corporation, they have $1 million in debt and it was not reported on the balance sheet. That has an impact on, the external user's decision, because if they have all this debt and you're going to lend the corporation money, you might say, hey, you know what? Since they owe so much money, I'm not going to, lend my money to this corporation, or a bank might decide that. But again, if that information is omitted, it has the potential to change the decision that an individual will make. So GAAP, generally accepted accounting principles, they put rules and procedures in place because, again, public companies, they are governed by GAAP and they have to adhere because there needs to be trust in the financial statements that external users are using. There's been a lot of fraud in accounting, so that's a whole nother story. But the key thing is external users, they are relying on the financial statements to make decisions. Next, we see this that is prepared at fixed intervals at the very least. Financial statements are prepared at a yearly basis. Sometimes it can be ad hoc. Sometimes it can be quarterly, monthly, but at the very least on a yearly basis, whether it is a calendar year from January 1st to December 31st, or fiscal year, which is any other 12-month period. So think of it from birthday to birthday. And then the focus of reporting is the company as a whole. In comparison to managerial accounting, again, the users of management, those internally, it can be objective and it can be subjective based ultimately on what management is trying to determine. The guidelines for preparation, it is not governed by anything. It's prepared according to the needs of management. The timeliness of reporting, it can be prepared at fixed intervals and on an as-needed basis. Let's say the same car company, they're deciding, hey, you know what? Maybe we want to come up with car model D, right? So they will use the managerial accounting reports to determine whether or not now is a good time to work on this car model D. And then the focus of reporting would be the company as a whole, or it can just be a segment. So in order to develop cost information, this is very important. So there are many considerations and choices in developing costing information. So let's say when you go to Starbucks and you buy a latte, or you go to a store and you purchase clothing, all of these things are what companies think about. So that helps them to determine, we're going to sell this latte for $6 versus us selling it for $10, or we're going to sell it for $6 versus selling it for $3. So all of these different things come into place. So what cost system should they use to record and report the cost of a product? How are they going to allocate overhead costs, such as equipment, depreciation to the products? How are they going to allocate support department costs, such as factory janitorial costs, to the products? How are they going to allocate joint manufacturing costs to products? How are they going to report fixed production costs, such as factory supervisory salaries? And how are they going to determine and report variances, differences between actual and planned costs? So these are all of the different things that essentially go into play. So management accounting within the organization, most large companies in terms of verticals and horizontals. So no two companies are exactly the same, right? They're not the same. So verticals, they're sometimes referred to as business units. And the reason being is it because they're often structured as separate businesses within the parent company. And vertical, this develops products that are sold directly to customers. And then on the other hand, we have what's called horizontals. And these are departments within the company that are not responsible for developing products. And horizontals, they provide services to the various verticals and other horizontals. All right. And just a key thing, quick side note, in the event that, let's say you struggle, you don't remember what is vertical and you don't remember what is horizontal. So when you see vertical, think of your vertebrae, our spine that goes from top to bottom. And when you see horizon, think, or horizontals rather, think of the horizon, right? The sunset, which I love, sunset and sunrise. And that's generally from left to right. So vertical, you think of your vertebrae, your spine, top to bottom. Horizontal, you think of the horizon from left to right. So this is just a quick example, and it just helps to, we're looking at McAfee Company, and this is a partial organizational chart. And this just kind of helps to bring to greater light what we just discussed about verticals and horizontals, because again, no two company structures are identical, but most of these large companies, they're organized in terms of verticals, top to bottom, and horizontals from left to right. So here we see the executive vice president for the consumer business unit and the executive vice president for the business unit. These are verticals. Then we have horizontals. We have the executive vice president for sales and marketing, for the chief technology office, the senior vice president, and things of this nature. So this is, again, just a greater depiction to help you understand the verticals and the horizontals. So now we officially move on to manufacturing operations. So it is very, very important to distinguish between a service business, a retail business, or a manufacturing business. So a service business, this would be like an accounting firm, a tax firm, right? They essentially provide services to a client. Next, we have retail. This is essentially, let's think of IKEA, right? IKEA, they purchased finished goods and they resell it to their customers. Manufacturing, on the other hand, this is essentially where the company, they are taking the raw materials and they are creating a finished product. So most of the managerial accounting concepts that apply to manufacturing businesses, they also apply to service and retail businesses. So just keep that in mind. So it states, as a basis for illustration of manufacturing operations, we have a guitar manufacturer, Legend Guitars, that is going to be used in this chapter. So here's essentially how it works. We see the operations of Legend Guitars. So the customer places an order rather. They're like, hey, I want this brand new guitar. Now, Legend Guitars, they have the raw materials, they have the wood, they have the guitar strings, the guitar bridge, and now they are going to put these raw materials together in order to come up with this finished guitar. So it has to go through the cutting department. It has to go through the assembly department, and maybe there are other departments, but you essentially get the gist. It's the raw materials going through this process to become a finished guitar. So as it relates to building this guitar, and as it relates to any manufacturing company, there are direct, or companies in general, honestly, there are direct and there are indirect costs. So a cost is a sacrifice made to obtain some benefit, and in managerial accounting, costs are often assigned to a cost object. A cost object, it can be anything to which the costs are assigned, and it'll vary obviously depending on the decision-making needs of management. Direct costs are identified with and can be traced to a cost object, and indirect costs are not identified with or traced to a cost project. So here we see a direct cost for manufacturing this guitar is going to be the wood, right? If, well, I mean, you can use other material, but let's just say that Legend Guitars, they specialize in wooden guitars, because I know that they use other material. But let's just say, for this example's sake, that they only focus on wooden guitars. If you have no wood, you have no guitar, all right? So the wood is going to be a direct cost. Then we also have, other things like the strings and um, the screws, the nails, the different pieces, everything that you need to essentially put together the guitar. Those are considered direct costs. However, indirect costs, they are not identified with or traced to a cost object. So this would be like the production supervisor and things of that nature. And we'll go a bit more into detail as we go on in the PowerPoint. So it's very important to classify direct versus indirect costs. So the key thing is we need to identify a cost objective. And again, the cost objective can be anything to which the costs are going to be assigned, and it varies depending on the decision-making needs of management. And we're going to determine, can it be identified? So if it's traceable, then it's a direct cost. And if it's not traceable, then it is considered an indirect cost. So now we break it down even further, right? As it relates to the manufacturing of the guitar. So the cost of a manufactured product, it's going to include the cost of materials used in making the product. All right, so let's just say they have all of this wood, they have all of these strings, these nails, these glue. If there's not a process, then the wood is just going to stay, you know, together. I mean, we live in this day and age where, there's technology, there's equipment and things of that nature, but at the end of the day, there's still some type of labor that's being put in place, right? So we have direct materials, we have direct labor, and then we have what's called factory overhead. So our direct materials, and as we know, we're using this example with Legend Guitars, we know the wood is definitely a direct cost. They specialize in wooden guitars. If there's no wood, there's no guitar. So manufactured products, they begin with the raw materials that are converted into the finished product. And in order to be classified as a direct materials cost, the cost needs to be both of the following. It needs to be an integral part of the finished product, and it needs to be a significant portion of the total cost of the product. So the reason why this is important is because we saw the cost for, or we saw some of the materials used for the wood. So we know wood more than likely is probably going to be one of the most expensive things, but let's think about the strings, right? So in order for it to be considered a direct material cost, it needs to be both of the following, not one or the other, but both. An integral part of the finished product. Is that important for a guitar? Of course, right? If you don't have any strings, you don't have any, guitar essentially, right? There's going to be no sound. But here we see the second requirement is that it's a significant portion of the total cost of the product. The strings, probably not as much. So therefore, the guitar strings, the glue, the nails, the things of that nature, because it's an insignificant part of the total cost of the guitar, and it's going to be difficult to trace it accurately in such case, then it would not be considered a direct material cost. Instead, it would be indirect. So here we have some examples of the direct material costs. Again, obviously wood, the cost of the electronic components for television, silicone wafers for microcomputer chips, tires for an automobile. So these are things that are very important. So they are an integral part of the finished product and a significant portion of the total cost of the product. So those two requirements need to be met. Next, we have direct labor. So most manufacturing processes, they are going to use employees to convert materials into finished products. And the cost of the employee wages, obviously, that's going to be an integral part of the finished product. And when it is considered a direct labor cost. And much like direct materials, there's the same two requirements for direct labor. It needs to be an integral part of the finished product, and it needs to represent a significant portion of the total cost of the product. So some examples of direct labor costs, this would include the wages of employees who cut guitars out of raw lumber and they assemble them together, the mechanic wages for those who repair an automobile, or also assembler who assembles a laptop computer. So obviously, if these individuals are not doing their job, then there will be no guitars, there will be no automobiles, there will be no laptop. So that is considered a direct cost. And again, the two requirements need to be met: an integral part of the finished product, and it needs to represent a significant portion of the total cost of the product. Next, we move on to factory overhead. So think of it, we have direct materials, direct labor, and then if it's not direct materials and if it's not direct labor, then it's considered indirect. So any costs other than direct materials and direct labor that are incurred in the manufacturing process, they're combined and classified as factory overhead. And sometimes it's referred to as manufacturing overhead, factory burning. Basically, all just means the same thing: any indirect costs associated with manufacturing the product. And all factory overhead costs are indirect costs of the product. And some factory overhead costs include the following: so heating and lighting the factory, repairing and maintaining the factory equipment, property taxes on factory buildings and land, insurance on factory buildings, and depreciation of factory plant and equipment. So these cannot directly be traced to the product, or maybe it doesn't represent a significant portion of the cost. So therefore, since it's indirect, it is lumped into this factory overhead account. So next we have what's called prime costs and conversion costs. So our prime costs, that's basically our direct materials and our direct labor. And then we have our conversion costs, which is converting it into the final product. And that is essentially our direct labor and our factory overhead. So direct materials, direct labor, and factory overhead costs, sometimes they can be grouped together, in order to analyze and to report. So the two common groupings, as we see here, prime costs, and sometimes, it can be referred to as DM, direct materials, DL, direct labor. And then this would essentially be direct labor, and these are basically the cost of converting the materials. Is basically right in the middle, is both a prime cost, also cost. So here we have some examples of product costs and period costs for Legend guitars. So the reason why this is important to distinguish is because for financial reporting purposes, costs are going to be classified as either product costs. These that will be those that are directly tied to the product itself. So that would be our direct material, direct labor, and factory overhead. And then we have what's called period costs, which we'll see on the next slide. So once you think of the product, again, just think of DM, direct materials, DL, direct labor, and everything that's not direct materials and direct labor, which falls under factory overhead. All right. So next we have product costs, period costs in the financial statements, and period costs. These are essentially the selling and administrative expenses. So selling expenses, this would be like marketing the product, essentially delivering the product to customers. So selling expenses, and sometimes maybe there are sales reps, and the sales reps, they are basically going to different organizations, different businesses in order to pitch the sale of the product. But it's not directly tied to the manufacturing of the product itself. So that would be a selling expense. And then we have administrative expenses, and these are incurred in managing the company and not directly related to the manufacturing or the selling function of the business. Next, we have financial statements for manufacturing business. So the statement of stockholders' equity and the statement of cash flows for a manufacturing business, it's similar to those for both service and retail businesses. However, the balance sheet and the income statement of a manufacturing business is going to be more complex. So if we think of it realistically, right? If we think of IKEA, we'll use that example with IKEA, and let's say IKEA, they purchase podiums from I Make Podiums Corporation, right? Just making the company up. So for IKEA, let's say the podium costs $500. All they essentially need to do is track how many podiums they purchased, and the cost of the podiums. And let's say they purchase 10, right? So they know every time they sell a podium, the cost of it is 500. And again, in order to make money, you need to spend money. So maybe IKEA now sells that unit for $700. So they sell the podium for $700 and they purchased it for 500. Therefore, for every sale of a podium, they earn 200. Easy peasy, right? They have the finished product. Now, on the other hand, when we think about I make podiums, on their balance sheet, they essentially need to track the raw materials, right? So they need to track how much wood do they have. They essentially need to track how much glue do they have and things of that nature. So that is essentially why reporting for a manufacturing company, it can be a bit more complex. And then we need to track inventory, right? Is it just raw materials? And if not, is it work in process, right? Because maybe sometimes they took some of the wood and they put it into production, but it's not yet quite finished. So we have work in process inventory, and then we have finished goods inventory. So it can be a bit more complex for a manufacturing company. And again, this is because the manufacturer makes the products that it sells and it must report product costs. The reporting of product costs, they primarily affect the balance sheet and the income statement. So the balance sheet, a manufacturing business reports three types of inventories. As mentioned, we have the materials inventory, sometimes it's referred to as the raw materials inventory, and this consists of the costs of the direct and indirect materials that have not yet entered the manufacturing. If we look at the warehouse, we're going to keep using legend of wood, right? Next, we have work in process inventory, and this consists of direct materials, direct labor, factory overhead for products that have entered the manufacturing process, but they're not yet completed, right? So as mentioned, they're started, but not yet finished. So that would be considered work in process inventory because you also need to track that. And then lastly, we have finished goods inventory, and this consists of completed or finished products that have not yet been sold. So this is just a quick example, a balance sheet presentation of inventory in a retail versus a manufacturing company. So I gave the example with IKEA, right? IKEA, they only need to track the amount of podiums that they purchased from We Make Podiums. However, We Make Podiums, they need to track the raw materials, the work in the wheels, all of those things, they need to track the work, the raw materials that are in production, also referred to as work process, and they also need to track finished goods. So the inventory section is a bit more complex for the balance sheet because there's more to consider for a manufacturing company comparison to a retail company. Same for income statement. There's a little bit of a nuance for a retail business. We start off with our beginning inventory, and then from there we add any purchases. From there we determine what our inventory available for sale is, and then once we subtract our ending inventory, we get our cost of goods sold. For a manufacturing business, on the other hand, we need to determine the cost of goods manufactured. So the key thing is it's a little similar. But again, just a little bit more nuance. With a manufacturing business, we also want to determine our gross profit, and the gross profit is always the sales minus the cost of goods sold. So we get to the same bottom line for both the retail and the manufacturing business. It's just a little different. Manufacturing, there's more things to consider because there's the raw materials in process, in production, and then finished goods inventory. So next we move on to cost of goods sold and cost of goods manufactured. So one thing that I love about accounting is that a lot of times the definition is in the word in and of itself. So cost of goods sold. What is the cost of the items that you sold? So we go back to the example with the essential water. If I purchased the essential water for $3, then in such case, the cost of goods sold would be the $3. So a retail business, they determine their cost of goods sold by first adding their net purchases for the period to their beginning inventory. This helps to determine the inventory that's available for sale during the period, and the ending inventory is then subtracted to determine the cost of goods sold. A manufacturing business, they make the products they sell using direct materials, direct labor, and factory overhead. So a manufacturing business, they need to determine their cost of goods manufactured during the year. So fairly similar. And the cost of goods manufactured, it's determined by preparing a statement of cost of goods manufactured. So again, fairly similar to cost of goods. So here we just have this quick example of an income statement of cost of goods sold manufactured. So again, we first start off with the statement of cost of goods manufactured. And after we factor in the work in process inventory, the direct materials that were being used, direct labor, and factory overhead, which, determines our product costs. Again, product costs are direct materials, direct labor, and factory overheads. Once we factor those things in, then the cost of goods manufactured is transferred over to the income statement. Here we just have a flow of the manufacturing costs. So with our manufacturing costs, again, we factor in DM, DL, factory overhead. Sometimes it's direct and sometimes it's direct. And then on the balance sheet, we factor in the raw materials, the work in process inventory, which is the inventory or the raw materials rather, that is in production but not yet finished. And then lastly, we have the finished goods inventory. So again, fairly similar cost of goods sold and cost of goods manufactured. And then from there, it is reported on the income statement. So this brings us to our last objective, the analysis for decision-making, utilization rates. So a utilization rate, this measures the use of a fixed asset in serving customers relative to the asset's capacity. So a higher utilization rate is considered favorable, whereas a lower utilization rate is going to be considered unfavorable. So obviously different service industries, they might have different names and computations that's being used in order to measure the utilization rate. So here we have this example. In the hotel industry, utilization is measured by the occupancy rate, and it can be computed as follows, right? So the guest nights, how many nights are they staying, divided by the available rooms per night, and that would help to determine the occupancy rate. So in order to determine the guest nights, we will factor in, well, how many guests did it to begin with? The number of guests multiplied by the number of nights per visit. And then the available rooms per night, this we calculate as the number of available rooms multiplied by the number of nights per the time period. All right, so here we just have this quick example of service industries, services, and companies. So again, service industries, they are providing a service, not a tangible product. So we have Con Ed or Consolidated Edison. They provide utility services, electric power generation. We have FedEx. This is a company that is in the transportation service industry. An example would be overnight delivery. Next, we have Facebook. Facebook is considered social media. The service industry would be information, right? So there's a lot of different service businesses. And again, a lot of what we learned in this chapter is not just for manufacturing businesses, but it also can be applied to service and retail-based businesses. And then here we just have a quick, exhibit that covers managerial accounting differences between manufacturing and service companies. So obviously manufacturing companies, they use materials, they use work in process and finished good inventory. Services companies, generally the inventory is often limited to supplies. So, if you have a tax firm, for the most part, you're going to buy some printed paper, you're going to buy, some pens and things of that nature. But the key thing is with inventory is that you purchase something with the intent to resell it. So something important to keep in mind. Manufacturing costs is considered both product, which is DM, DL, and factory overhead, and service basis business rather. They only use period costs, right? So again, this is just kind of going over some of the differences. You can take time to, dive a bit more into the differences between the two per this exhibit. Feel free to do some additional research. So this brings us to the end of chapter 15, Introduction to Managerial Accounting. So now that the lesson is ended, you should have learned how to describe how managerial accounting supports the management process, its differences with financial accounting, and its place within the organization. Again, financial accounting, we think of external users, creditors, investors. They're using the financial statements to make a decision versus managerial accounting, where it is used internally by management to make certain decisions. Financial accounting is governed by GAAP. Managerial accounting is not. Next, we described and illustrated the nature of manufacturing operations, including the different types and classification of costs. So we know we have direct costs, we have indirect costs, and then we also know for product costs, this is essentially the direct materials, direct labor, and the factory overhead. And then we also mentioned our prime costs, which would include selling and administrative expenses. We also described and illustrated financial statements for a manufacturing business, including the balance sheet, statement of cost of goods manufactured, and the income statement. And then lastly, we described and illustrated the utilization rates and evaluating performance for service companies. So this brings us to the end of chapter 15, Introduction to Managerial Accounting.